Topic introduces central counterparties, CCPs, as financial market infrastructures that reduce counterparty credit risk by acting as intermediaries between buyers and sellers in cleared transactions. When trades are centrally cleared, the CCP becomes the legal counterparty to both sides of the transaction through a process known as novation. This structure transforms bilateral exposures into exposures against the CCP itself, reducing interconnected counterparty risk among market participants. CCPs are widely used in derivatives, futures, options, and securities financing markets. Following the global financial crisis, regulators expanded mandatory central clearing requirements for standardized over-the-counter derivatives to strengthen market transparency, improve risk management, and reduce systemic vulnerabilities. The topic further explains the core operational functions of CCPs within financial markets. CCPs provide trade matching, settlement services, margin collection, default management, and risk monitoring for cleared products. Participants are required to post initial margin to cover potential future exposure and variation margin to reflect daily market value changes. These mechanisms ensure that losses are recognized and collateralized continuously. CCPs also maintain default funds contributed by clearing members to absorb losses that exceed individual margin requirements. By standardizing risk management practices and centralizing settlement processes, CCPs improve operational efficiency and enhance confidence in financial markets, particularly during periods of heightened volatility and economic uncertainty. A key topic is the role of CCP membership and the responsibilities of clearing participants. Clearing members, typically large financial institutions, interact directly with CCPs and assume obligations related to margin payments, default fund contributions, and settlement activities. Non-clearing participants generally access CCP services indirectly through clearing members. Because CCPs rely heavily on member solvency and liquidity, strict membership standards are established regarding capital adequacy, operational capacity, and risk management capabilities. CCPs continuously monitor member exposures and financial conditions to identify emerging risks. Strong participation standards help protect the clearing system from disruptions caused by weak or highly leveraged institutions. Topic also focuses on CCP risk management frameworks and the mechanisms used to control financial and operational risks. CCPs face several forms of risk, including counterparty credit risk, liquidity risk, operational risk, and systemic risk. Margin requirements are among the most important risk controls because they provide immediate financial protection against adverse market movements. CCPs use sophisticated quantitative models to estimate potential future exposures and determine appropriate margin levels. Stress testing and scenario analysis are conducted regularly to evaluate resilience under extreme market conditions. Default waterfalls establish the order in which losses are absorbed, beginning with defaulting member collateral and progressing through default funds and CCP capital resources. The topic also discusses the challenges associated with concentration risk and procyclicality within CCP structures. Because CCPs centralize clearing activities, they may become systemically important institutions whose failure could threaten broader market stability. Large concentrations of risk among major clearing members increase vulnerability to defaults during periods of stress. Procyclicality is another concern because margin requirements may rise sharply during market volatility, creating liquidity pressures for participants and amplifying financial stress. Regulators therefore require CCPs to maintain robust governance, recovery plans, and sufficient financial resources to withstand severe market disruptions. International standards emphasize transparency, resilience, and strong operational controls within CCP risk management frameworks. Topic also examines the broader market impact of central clearing and the transformation of financial markets following regulatory reforms. Central clearing has significantly increased transparency in derivatives markets by standardizing reporting, pricing, and settlement processes. Bilateral counterparty exposures have been reduced, lowering the risk of contagion across interconnected institutions. Improved collateralization and daily margining practices have strengthened market discipline and enhanced investor confidence. However, central clearing also increases demand for high-quality collateral, creating liquidity pressures and influencing funding markets. Smaller institutions may face higher operational and compliance costs associated with clearing requirements, potentially affecting competition and market participation within the financial sector. The topic further explains how central clearing influences market liquidity, pricing, and systemic interconnectedness. Standardized cleared products generally experience greater liquidity because participants can trade more efficiently within transparent clearing frameworks. At the same time, concentration of exposures within CCPs changes the structure of systemic risk rather than eliminating it entirely. Financial institutions become interconnected through their reliance on shared clearing infrastructures and collateral management systems. During periods of market stress, sudden increases in margin calls may intensify liquidity shortages across financial markets. Policymakers and regulators therefore closely monitor CCP operations and collateral dynamics to ensure that clearing systems continue supporting financial stability under adverse economic conditions. Finally, topics emphasize the critical role of central counterparties in modern financial systems and post-crisis regulatory reforms. CCPs reduce bilateral counterparty risk, improve transparency, and strengthen market discipline through centralized clearing and collateral management. Effective CCP risk management requires sophisticated modeling, robust governance, stress testing, and legally enforceable default procedures. While central clearing has enhanced market resilience significantly, it also concentrates systemic importance within clearinghouses themselves. Financial institutions and regulators must therefore maintain strong oversight, liquidity planning, and operational safeguards to ensure CCP stability.